Okay, welcome to Unit 5.3 via Module 5. And what I'd like to do in 5.3 is summarize some key components for Module 5 as they pertain to your CLEP final exam in financial accounting. First, I'd like to talk about a very intricate component that all financial operations for businesses entail. Not that they want to, but it's par for the course somewhat. And that's called a contingent liability. Okay, so a contingent liability is kind of intricate, and I'm going to break it down pretty simple for you. Okay, so as you know, a liability has some type of cost to the business, right? And it's part of the accounting equation. But nonetheless, anytime it's a cost, in and of itself, it's a form of a loss, 100% form of a loss. Remember that. So a contingent liability, the key word there being contingent, okay? Not my favorite word, but definitely one that needs some addressing. Okay, so a contingent liability is a potential yet unknown cost. Okay? Now, this potential yet unknown cost, because it is potential yet unknown, what do we know about it? It may or may not occur. And trust me, businesses do not want it to occur. Now, these particular liabilities are not recorded normally in the company's accounts or shown on the balance sheet unless okay, the scenario, whatever the business is encountering, where now the loss or cost to the business falls within the confines, if you will, of contingent liability, unless this scenario presents liabilities as both probable okay, and reasonably estimable. Like we know something's about to go down within our business. It's beyond our control, but we might be able to estimate the actual loss to it, okay? Therefore, that would be considered, both of these variables, contingent. Or, even worse, where it's basically considered a worst, and this is legal terminology, case financial outcome. And we're talking worst of the worst. And I'll explain. Now, before we get to that, there's three examples of contingent liabilities. And I want to include, by majority, where they could fall. Number one, a warranty on a product that the company maintains and usually sells. Now, let me just backtrack for a second. If a worst case scenario financial outcome occurred, or a business was entangled in a probable and estimable situation, it could involve one of their products, not their whole business in and of itself, but it could involve one of their products, and it could involve a warranty on a product, okay? So it could take little bits and pieces of elements from these things as I'm giving them to you. It could also have to do with a guarantee on another party's loan. So that would be a third-party loan. Now, who are they talking about? Well, let's just say there's two situations where this could occur. If a contingent liability occurred and you know you're taking a loss, and you know you're taking a loss on a guarantee of another party's loan, maybe they defaulted on the loan. But most importantly, who is this third party? Who are these people? It could be one of your investors. Okay? Or it could be an actual business that you took over, where you're actually having them, the people that you took over, still run the operations. They also may be still running financial activity and investing activity. Nonetheless, you are the owner. Unfortunately, because of the way contingent liabilities do occur, you may not know until it's too late. Okay, and number 3, lawsuits. Lawsuits happen all the time. Businesses expect them. Corporations is even more so. Things happen in the workplace, and things happen with products. You know, there's so many different types of lawsuits that could occur out there, and you hear about them every day. There's a reason that huge billion-dollar franchises put on their cups of coffee, pretty much, be careful, this beverage is hot. So, you know, little things like that, but nonetheless, you know, there's preventatives out there because they know, businesses know that contingent liabilities do occur. All right? Now, there's 3 categories of contingent liabilities. All right? Number 1, it's called high probability. Okay? Now, high probability are the costs that actually can be estimated, okay, and loss must be disclosed and described on the financial statements. So this is two-pronged, and it really fits the core definition, by and large, of what a contingent liability is. It's almost like, even though I mentioned to you that it's potential and unknown, probable and estimable, and it may or may not happen, high probability, it kind of writes itself. It's like saying, okay, I'm a small business, I'm a medium business, or I'm a corporation. This is most likely going to happen. All right? Once again, those costs can be estimated, and the losses must be 100% disclosed and described in financial statements. Now, one scenario I'm going to give you is pretty simple, and it has to deal with a long-term asset, and that would be property. So we know that depending on where your property is located, let's say you decided to buy a bunch of houses down by a shore area. For instance, I'm originally from New Jersey. I don't know if you've ever heard of the New Jersey Shore. Probably you have. After Hurricane Sandy, the majority of the Jersey Shore was decimated, and a lot of home improvements had to be initiated, to the point where they actually came up with a new law under catastrophic occurrences, okay? So a contingent liability, you're living by the water. Let's say if you live by the water, you know you need more flood insurance than the average person. But the contingent liability would lie in the actual occurrence, right? And wiping a home out, et cetera, et cetera. Now, all these homes down there need new foundations, okay? Now, the sale will deem and allow for a cost to be estimated, and the loss is 100% documented, okay? So, there are some times when people, overstate, the damage that's done. And sometimes they overstate the damage that's done because they know in certain cases that higher powers like the government could come in, step in, and provide for them. But what happens is estimators come out and all that, and adjusters from insurance companies, et cetera. And that's why even in the world of accounting, purchasing insurance goes down as an expense, and it's a necessity, not always a liability. Okay, it's actually to prevent liability. So your insurance company is going to send somebody out and deem something a loss or a total loss, and that will be able to tell how you can recover from that. Another high probability example would be take a large retail franchise like a Toys R Us, maybe a Marshalls or a TJ Maxx, something like that. Now, part of my background plays into this as far as on the due diligence side, but I will tell you, these corporations put money aside because of the high probability that they will take losses in theft, i.e. loss prevention. So depending on the size of the corporation, they will put millions of dollars aside ahead of time for the financial and fiscal year for those types of liabilities. All right, now that's highly probable. So in those cases, that's why that happens. Now we have medium probability. These are costs that are in between high and low. Okay, that must be disclosed in statements if the contingency is probable, yet not necessarily probable. So it would really, really vary on the type of scenario that the business attempts to go into. A lot of businesses go into different types of investments, different other ventures that are not alike their normal business operations. But one prime example of a contingent liability would be a lawsuit, like I mentioned before, where it's not always expected, but you're not completely knocked off your feet when it does happen, because anybody could sue you at any time, especially if you have money and you own a business. So sometimes these contingent liabilities suddenly arise and unfortunately catch both management and investors by surprise. Nonetheless, it's why you have money for contingent liabilities. You know, with BP oil, whoever thought the Deep Horizon oil spill would have occurred? And if you're working for Volkswagen in 2015, massive liabilities from an emission scandal occurred and became a huge scenario for a contingent liability. So, you know, we're talking about accidents, and we're also talking about things that would be considered scandalous too. Okay, now let's talk about low probability, and I have a really prime example for you that you may see again on the final exam. Now, with low probability, there's no reporting whatsoever required due to the fact that there's a very, very, very low likelihood of the cost being triggered. Now, the fact that there is or maybe no reporting, it has to do with the actual actions and sometimes policies that are in place already in business operational procedures that employees know to follow through with before they occur or as they occur. And they can probably gauge them based on how the policies are written, whether it's going to be high or low. But let me give you an example, okay? So let's say you own a business and you sold a bunch of products to a client, okay? You actually sold one area of your product line. Your product line that you sold this one particular client, you sold them faulty products. You didn't know, or else you never would have sold them in the first place, okay? Now, because you sold a faulty product, we had significant warranty claims as a result. However, based on the methodology we use and based on the policies we have in place, and we acknowledge our contingent liabilities and have funds to pay for them and can recognize high versus low, what we did was the following. If we isolated that bad product, we said, hey, we don't want any more faulty products going out, okay? We don't want any more significant warranty claims. No, no, no. That's bad news. We isolate that bad product. And then what we're going to do is just say to the client we sold to, as well as other people that potentially have come into contact with the faulty product, we're going to recall it. We're smart enough to recall the product. And you've seen that in automobiles. You see that with food. Unfortunately, two very important things in our lives, how to get around and how to survive, right? But most importantly, we isolate the bad product and we recall it. And sometimes we go as far as to broadcast it on news, on public access news at the right time, because it's that potent to society or clients, right? And then what we want to do immediately after we recall it is settle as many warranty claims as humanly possible. That's a big deal because we don't want extraneous lawsuits coming out and any more problems. And we will obviously, due to the situation, possibly now consider, depending on how we're manufacturing, what materials we're using, et cetera, consider situations like this that we've now gained experience on. We may now bump it up from low probability to medium probability to prepare for the future. Okay, now one more thing, chances are low for dealing with similar warranty issues on the product in the future based on the protocols we put in play. And I'm talking about isolating the bad product that we did, recalling it, and settling all warranty claims with money in our contingent liability account. So that's how we basically go about that. And that's all we have for you in 5.3.